The US stock market index has gained 1,000 points throughout 2023, something that took approximately 10 years back in the 1990s. To many people, this looks like an unsustainable trend, something we could have also perhaps said back in 1999 at the height of the dot-com bubble, or back in August of 1929 during the famous speculative bubble of the 1920s. Many people believe we are in a stock market bubble today and we're due for a large period of consolidation, just like we saw following 1999. And it's a fair question. If you had invested $1,000 back in 1929, 1968, or 1999, in each case it would have lost approximately 60% of its purchasing power over the next 10 years, so becoming worth about $400. This is the US stock market, but adjusted for inflation. So it gives you the real actual performance of the stock market, and this shows us there is such a thing as a bad moment to be invested in the stock market. In fact, many people use this chart to justify why it's a bad idea to be investing in the US stock market today. It looks like the stock market is too high compared to its long-term growth trajectory, which you can see from this line here. And that would be similar to previous stock market bubbles that we've seen throughout history, suggesting that we are in another stock market bubble today, and that people investing in the stock market will see the value of their investments decline over the next 10 years. Now, one of the key defining characteristics of stock market bubbles is the massive return that can be observed leading up to the peak. This was the case for the 1929 stock market bubble, for example. The US stock market returned almost a staggering 300% over the course of 5 years leading up to the peak in October of 1929 before crashing by around 80%. When we look at other bubbles, they typically do generate this type of return in a 5-year time period. It was also the case for the price of gold in the 1980s that rose 400% in 5 years before crashing by around 70%. We also witnessed these types of returns with Japanese stocks in a speculative mania in the late 1980s, and also biotech stocks in the US in 2015. All of these well-known bubbles saw price move up by around 250% within 5 years before crashing by around 50 to 80%. Now, today in 2024, the US stock market's return over the last 5 years has been approximately 100%. So that's around 3 times less than what we've typically seen during these well-known bubbles, which is one of the arguments to suggest that the S&P 500 is actually not in a bubble today and could actually have a lot more room for upside before this market looks speculative. But asset bubbles are not just about the price, it's also about how much risk investors are taking. In 1929, margin debt was around 6% the size of GDP. Margin debt is basically how much leverage investors have on the stock market. We can see it was also very high back in 1999 during the tech bubble, where margin debt represented around 3% of GDP. In 2021, it reached levels that were getting incredibly high relative to history, but we saw a lot of that leverage disappear in 2022 when the stock market corrected by 25%. A lot of people probably got hurt, but today margin debt represents around 2.4% of GDP, which is around the historical average. So from this standpoint, it also doesn't seem investors are taking a huge amount of risk in the stock market today. But just because investors aren't taking massive risk doesn't mean the stock market isn't expensive. The S&P 500's PE ratio is currently at 20. This is the upper end of the range we've seen for S&P 500 valuations over the last 40 years. The PE ratio is the price that investors are willing to pay for earnings of the S&P 500 at any given time. So that's basically how expensive stocks are. We've seen the stock market valuations be more expensive than today 2 times in the last 30 years, once in 2021 where PE ratios reached 23, and once in 2000 where PE ratios reached almost 25. Today, investors are willing to pay $20 for each dollar that S&P 500 companies are going to be earning next year. That's why these are called forward PE ratios, because they're taking into account future earnings that are based on estimates from analysts. When we look at PE ratios that take into account past earnings, those are at around 32 today, and that's actually one of the most elevated levels looking back 150 years, a similar level to the late 2000s 2000s and the 1929 tops, which are recognized as having been stock market bubbles, and of course saw considerable declines afterwards. In 2021, we also had valuations at higher levels than today. We didn't see a massive stock market decline, we just witnessed a relatively small bear market in 2022. So these high valuations today don't necessarily guarantee that we are in a stock market bubble and that we're going to see this massive crash. In fact, theoretically, the valuations of the stock market can stay this expensive for an extended period of time, or better yet, get even more expensive. But what history does suggest is that buying stocks when valuations are high, like in 1999, in 1970, or in 1929, is less of a good idea than buying stocks when valuations are low, like after World War I, World War II, the early 1980s, and 2009. Investors that were buying the stock market at these points would have seen spectacular returns over the course of the next 10 years, and that's what this chart shows us. It compares the stock market returns over the next 10 years to the stock market's valuations. On the right, we have all the years where the stock market was cheap. The returns were typically around 200% looking out over the next 10 years. So when you're buying the stock market when it's cheap, you can expect to triple your money over the next 10 years. But when we come over to the left side of the chart, all the years in history where the stock market was expensive, and you can see the returns over the next 10 years are around 50% when stocks are very expensive. So that's generally the trend, but this relationship is far from being perfect. As you can see, some of the best market returns in history, around 350% return in 10 years, were made when the stock market was on the more expensive side of the valuation range. And this is the valuation that we have currently in the stock market today. If we follow the path of other instances in history where the stock market was at a similar valuation, we can expect a very unimpressive 50% gain over the next 10 years. But if stock market valuations stay high or even continue rising over the next 10 years, this chart could possibly end up looking something like this, where the stock market yields a 200% return over the next 10 years, despite the fact that it is expensive today. Which is kind of what happened for these dots right here. These occurred in the late 1990s, and this contributed to the huge rise in market valuations that we witnessed during that period. This was during the technology stock market bubble, which was in large part responsible for making the stock market so expensive. The PE ratios of technology stocks back in 2000 reached a staggering 48, around twice the valuation of the market. In fact, we have somewhat of a similar story today, where technology stocks are also becoming quite a bit more expensive than the rest of the stock market, especially over the last year. When we look at the equal weighted S&P 500, which has a smaller weight of technology stocks, we see that the rest of the stock market is actually priced a lot more reasonably at around a PE ratio of 17, which is actually a pretty reasonable price. So that begs to ask the question whether technology stocks are in a bubble today, being almost twice as expensive as the rest of the market. Of course, we can directly observe that valuations were a lot higher during the tech bubble of the late 1990s, which immediately makes it difficult to compare today's technology stocks to the tech bubble. And the reason these technology stocks are so expensive may just be because they're extremely profitable companies. This is a chart that shows the profit margins for each S&P 500 sector. Technology stocks are the most profitable businesses in the US stock market. They have profit margins hovering around 24%. For comparison, the S&P 500 as a whole has profit margins of around 13%. So technology companies are almost 2 times more profitable than the rest of the stock market. And that is very different to the profitability of technology stocks back in 1999, where they were actually at a mere 14%, barely higher than the S&P 500's profit margin. Since then, we've seen technology stocks become extremely profitable. So not only are technology stocks much more profitable today than 1999, but they're also a lot cheaper. And many like to point out this profitability and say that technology stocks should be this expensive. Today, the 7 largest technology stocks seem unstoppable. These magnificent 7 stocks, as they're called, together make up almost 30% of the S&P 500's weight. These are some of the largest and most profitable businesses in the world today, which should be something that investors take into account when it comes to how expensive they are, and why some experts believe they should be getting even more expensive. In the early 1970s, we had companies like McDonald's, Coca-Cola, IBM, Bank of America, General Motors that made up a significant portion of the S&P 500. These were not the Magnificent 7, they were called the Nifty 50. They were some of the largest and and most profitable businesses in the world at the time, and investors were willing to pay a hefty price to own them. These nifty 50 stocks had a PE ratio of around 40 in December of 1972. That was much more elevated than the rest of the stock market at the time. That was at a PE ratio of around 18. Today, the Magnificent 7 stocks are at valuations that are very much comparable to the nifty 50 stocks back in the 1970s, and the rest of the stock market is also at comparable valuations. Now, following their peak in December of 1972, most of the stocks in the nifty 50 collapsed to much cheaper valuations, which pulled down the S&P 500 despite the fact that it wasn't as expensive. So this is one of the arguments that suggests that some areas of the market are in a bubble today, and that if the large caps in the S&P 500 see their valuations decline, it would likely also hit the rest of the stock market like it did in the 1970s. But even then, the reason why these Magnificent 7 stocks are so expensive is in large part because of Tesla and Meta that have PE ratios of 67 and 100. That's completely absurd, right? Why is a PE ratio of 100 absurd? Why can't the stock market have a PE ratio of 500, of 1,000? Who said that technology stocks being at a PE ratio of 30 is expensive? A PE ratio of 30 means that for every dollar of profit that a company makes, investors are willing to pay $30 to own that company. That means the company's earnings yield is around 3%. If you invested $100 in Apple stock, you can expect that your share of the stock will be earning $3 of profit each year. And that's fantastic, except that you can earn a 4% yield from just putting your money in a money market fund. So today you're earning less from owning the stock market than you are from just owning cash. That's what this chart shows you. It's the earnings yield of technology stocks minus the interest rate that you get for holding cash. And as I said earlier, it is negative today. Over the last 20 years, technology stocks have been more attractive than cash the majority of the time, except for very briefly in 2007 and also for 3 years between 1997 and 2000. Now, both of these examples happen to lead to around 50% drops in the stock market, which coincided with US recessions. Today's stocks are in a similar situation where they're yielding less than cash. This is very unlikely to stay the case for very long. Either we're going to see the yield on cash go down, and so stocks are going to become more attractive again, and that could happen if the Federal Reserve decides to cut interest rates, and or if the stock market falls, which would make the valuations less expensive relative to cash. That would probably only materialize if we see a recession like we did in 2001 and in 2008. Back in mid-2022, we communicated to our clients that technology stocks were incredibly attractive and likely make significant gains. But that was when their valuations were still reasonable. Today, what we're telling our clients is that we believe large cap technology stocks are indeed at risk of a market correction. You can sign up to our website if you want to find out more.